So, what if the secret to winning at investing isn't about predicting the future at all, but about getting a really good read on the present? We're going to dive into this idea called expectations investing. It's a super powerful concept that basically flips the whole game on its head. It says a stock's price isn't the finish line, it's the starting block. And look, this isn't just some random theory from a textbook. When a legend in the valuation world like Aswath Damodaran calls something a head whacker, you really got to pay attention. It's one of those ideas that is so powerful and so obvious once you hear it that it completely changes how you think about what a company is actually worth. So you might be asking, why do we even need a new approach? Well, frankly, because the old way just isn't cutting it. I mean, beating the market, it's ridiculously hard. So hard, in fact, that almost 90%, that's 9 out of 10 of professional fund managers, can't even beat a basic S&P 500 index fund over a 10-year period. Something's clearly broken. And a lot of that underperformance, it really comes down to the tools everyone's using. Most investors, professionals included, are just obsessed with the exact same short-term stuff. What's the next quarter's earnings per share going to be? What's the PE multiple? It's kind of like trying to win a marathon by just staring down at your own shoelaces. You're completely missing the big picture. Yeah, this focus on the short term really has investors chasing the wrong things. They're basically trying to predict a company's long-term value by looking at some pretty misleading clues. Okay, so this is where we flip some conventional wisdom right on its head. We've all been told the market is short-sighted, right? The reality? Stock prices are actually reflecting expectations for cash flows way out into the future. We're talking a decade or more. We think earnings per share is the king of all metrics. The reality? It's actually a pretty terrible proxy for real cash. And we think PE multiples tell you what a stock is worth. Nope. They're actually the result of what the market thinks it's worth. And if you want a perfect example of this disconnect, just look at Shake Shack back in 2019. On paper, things looked great. They reported over $24 million in net income. That's positive earnings, right? Awesome. But if you actually follow the cash, you see a totally different story. They burned through almost $17 million. How? Well, things like capital expenditures, building new stores. You got to remember this. Earnings are an opinion, but cash flow, that's a fact. And the market ultimately prices the facts. All right, so if the old way is broken, what's the fix? The cool part is, it's not about finding some new complicated tool. It's just a simple but really profound twist in how you look at the problem. So the traditional method, you've probably heard of it. It's called a discounted cash flow, or DCF analysis. It basically forces you to be a fortune teller. You have to forecast a company's future cash flows, which is, let's be honest, an incredibly difficult and error-prone thing to do. Then you calculate some value and compare it to today's price. Okay, now here's the twist. Expectations investing flips that whole process upside down. You start with the stock price. Think of it as a gift of information from the market. Then you work backwards from that price to figure out what kind of performance is already baked in or implied. Your job totally changes. You're no longer a forecaster. You're a reality checker. The question stops being what will happen and becomes, is what the market thinks will happen even reasonable? And that right there, that is the core mental shift. You're moving from the arrogance of trying to forecast the future to the humility of just reading the present. Asking what performance is already priced in is just a much, much more powerful and answerable question. So this isn't just some abstract philosophy, right? It's a real process. And to decode the story the market is telling us, we're going to need a map. And here it is. This is the map. It's called the expectations infrastructure. What it does is create a really clear link between the big picture business drivers, we'll call them value triggers, and the nitty-gritty financial metrics that actually drive shareholder value. It basically gives you a system for the whole process. And it all boils down to these 3 fundamental value triggers. Seriously, just about any change you see in a stock's price can be traced back to a shift in the market's expectations about one of these 3 things. How much the company is going to sell, what its operating costs are going to be, and what kind of investments it's making for the future. So what's the end game here? What's the whole point of this analysis? It's all about being forward-looking, but in the right way. You've probably heard that famous Wayne Gretzky quote, right? It's just the perfect metaphor for investing. See, most investors are skating to where the puck is right now. They're chasing today's news. But expectations investing, it's all about figuring out where the market's expectations are going to be next. And that, right there, is the bottom line. This is so important. You don't make money just by finding a great company. You make money by finding a company that is going to perform better than the market currently thinks it will. The entire game is about anticipating changes, revisions to the expectations that are already baked into the price. So, I want to leave you with a question. The next time you look at your portfolio, don't just ask yourself, do I own good companies? Instead, ask this. Do I actually know the specific story, the sales growth, the profit margins, the investments that the market is telling about each one of my stocks? And even more importantly, do I have a really good reason to believe that story is about to change?